Hello, Stephen Koukoulas here from Market Economics with the update for the good folk at Maxim Advisors, and wow, what a lot to catch up on. I'm not sure where to start, but I'll start, I guess, on the big picture view of the economy. Obviously, the two issues confronting the economy right now are the surge in inflation linked to the oil and petrol price increases and the downside risks to economic growth from those factors, plus the Reserve Bank hiking interest rates to try to counter that inflation problem that I just mentioned. So what we're seeing, inflation has spiked higher, 4.6% in the year to March. The underlying rate's a little bit lower, around about 3.3%, but obviously the price that households, businesses pay is the headline figure, and that's causing what has been a quite substantial slump in consumer sentiment, in business confidence. And when those two measures are weaker, we almost inevitably get a slowing in the economy. So here we are, concerned about the economic growth outlook, concerned about the inflation outlook, and which one of those finally peters out first, whether we get the trough in economic activity or the peak in inflation coming, will be the critical issue for policymakers. Speaking of which, the Reserve Bank have hiked interest rates 3 times so far this year. They're fighting inflation first. They're wanting to say that for us to have a better economic growth performance, we need to get inflation down first, and then we'll worry about growth and unemployment. Well, that's the state at the moment. They may change their minds later in the year if we find that the unemployment rate is to kick higher. But for the moment, the unemployment rate's nice and low, 4.3%, even though things like job vacancies and job advertisements are starting to trend a little bit lower. The other big news, of course, is the budget. And I'll spend a moment on that. That only came out a few days ago. Key issues there are the changes to negative gearing and capital gains tax laws, trust laws too, but I won't get into them. They're for another day. But the issue for those and their implications for the housing market are a little unclear. However, what we can conclude is there'll be some impact, negative, on house prices because the incentive for investors is obviously diminished. So they're going to step away from the market. And that, in a sense, is a good thing because it allows first home buyers to come in. But basically, there's going to be lesser demand for housing. And interestingly, these changes are starting to be contemplated by investors, by potential home buyers, at a time when house prices are already weakening. And they're weakening in Sydney at the moment. They're down about 1% since the start of the year. So in a sense, it's not a huge fall, but the momentum is down, and that's permeating through the coastal area of New South Wales. So I'm sure that's impacting on people listening to this video in the central part of New South Wales. So the bottom line is that the combination of these tax changes, of the unemployment consequences from the interest rate hikes, the slower growth, the petrol shock, gosh, I'm rattling off quite a few negatives at the moment, will put further downward pressure on house prices. Now, I'm not forecasting a house price crash. I don't think that's the case because underlying demand for housing is still reasonably strong from population growth. But we are seeing more than an element of nervousness creeping into the markets. That's something that I'll be watching very, very closely over the next few months. And I'm sure the Reserve Bank will be watching it too. And to the extent that house prices do come off, if there is a silver lining to that, it is that the RBA will probably not hike rates anymore. They don't need to because there's going to be a wealth and a confidence effect as the housing market slows. So the issues as we wind out the problems, the concerns for the economy, and there are a few, is what happens to the oil price? What happens to the Straits of Hormuz? Does the oil start to come through the Straits and get refined in Singapore and other countries so it comes to Australia and the price drops? Just as importantly as the supply of oil is the price that we are paying as a household, as business people. Number one. Number two, the rate hikes. As I said, we've had 3. Do we need any more? Probably not. But the inflation rate will be higher in the coming months, which will cause the RBA and the market to be a little bit nervous about what's happening. And interestingly, and no surprises, inflation's picking up in the US, in New Zealand, in Canada, in the UK, throughout Europe. Economies similar to ours, and those central banks are in the midst of perhaps hiking interest rates sooner rather than later as well. And for the budget, Yeah, the budget's actually a little bit contractionary. There's some cuts in spending. Sure, there's a bit of a recycling of the cuts back into the economy through some tax changes and the like, giving wage and salary earners a little bit of a tiny boost, if you like. But at the end of the day, the government contribution to the economy, which was one factor in the inflation pickup last year, is now starting to turn the other way. So, gosh, it's an interesting period ahead. We are going to see weaker consumer spending, but the little shining lights for me are going to be business investment, which remains reasonably positive. We're building lots of hotels and warehouses and these sorts of things, and that's going to be helping the economy offset the negativity in the housing, in the consumer sector. And in the housing market, well, it's a mixed bag. We're probably going to see more construction, but house prices still to weaken. How far they fall is the big question. So we'll update that in a few months' time when we've got a little bit more information about that momentum in house prices. So for the people at Maxim, I'm looking forward to hearing any feedback that you have on this, and hopefully sooner rather than later we get a face-to-face meeting with everybody there. But thanks very much. Good luck in the period ahead for the economy.